this recession that will come will be greater than the GFC. Yes? Hello and welcome to the Rich Dad Radio Show. I am Kim Kiyosaki. I'll be hosting today's show, and it could not be more perfect timing. Today, our very special guest is my go-to guy, self-taught macroeconomist, and just gives me the way it's happening. And I couldn't be more excited because we've got World War III, possibly. We've got inflation. We've got interest rates going up, going down, and then something unprecedented just happened. So I want to welcome George Gammon to our program. Welcome. Thank you for taking the time, because right now the world seems a little crazy to me, and there's all these different factors coming to play, and you're so good at putting the pieces of the puzzle together.
Yeah, well, thanks for having me, Kim.
Oh, absolutely.
I got to say, I thought we were friends. You're calling me an economist, and that's you're offending me right now.
Oh, I'm so sorry. That's the last thing I would ever do.
No, all joking aside, now I really appreciate you having me on, and it's always a pleasure.
Thank you. Well, I have always learned so much from you, George. And so I just want to jump into it. What's going on? What happened recently that, as you said, is unprecedented?
Well, we've got to go back about a year and a half or so. And what happened in the Treasury market is we had something called an inversion of the yield curve. So just to keep it super simple,
Okay.
the yield curve is just different maturities of Treasury. So let's just say we've got a 1 month Treasury, we've got a 1 year, a 2 year, 10 year, and a 30 year. Most people are very familiar with the 10 year because that's what usually mortgage rates are derived from, is the 10-year Treasury. They use that kind of in the calculation for mortgage rates. So usually what you'd have happen, just common sense, is that the long end of the curve, so longer term interest rates would be higher than short term interest rates, because obviously if you're lending someone money for 30 years, you're taking a lot more risk.
Right.
They don't pay you back. You're taking inflation risk, all these things, as opposed to just lending money to someone for 1 month or 1 year, where you're taking a lot less risk. And therefore, there's going to be a premium on that long-term maturity, and therefore the interest rate's going to be higher. You have to be compensated for that risk, basically.
Got it.
So this is the way interest rates should usually look, to where you have a steep sloping curve. What happens in an inversion, short-term interest rates go higher than long-term interest rates. So this is very unnatural. And the reason this happens is because you have, let's just say, financial institutions that I believe have asymmetric information, meaning they have a lot more information about what's happening in the global economy than I do, or even the Federal Reserve. And so they're looking out the global economy and they're saying, okay, things don't look that great. We're seeing recessions. We're seeing an economic slowdown potentially in the future, not now, but in the future. And therefore, we're going to buy the most safe and liquid asset we can get our hands on, instead of lending that money out, let's just say it's a bank, into the real economy, to where now we've got to take risk. We might be able to get a little bit higher return or a higher interest rate, but we've got to take much more risk. And that doesn't make sense right now because we see those storm clouds. So we're going to take that balance sheet, or we're going to take our ability to buy an asset, and we're going to allocate that instead to just buying the safest, most liquid asset we can get our hands on. And those are treasuries.
And so when the yield curve inverts, it's basically a signal that there's less confidence in the economy. Is that?
Yes, that's the financial institutions, and I call them the economic insiders. And this is you could look at Jamie Dimon, you could look at Larry Fink or Warren Buffett or Paul Tudor Jones, but it's not just those types. It's also the banks in the global monetary system, inside and outside the United States. They're seeing a lot more risk, and therefore they want to get into, let's call it, a safe haven asset. So they buy treasuries, and they want to buy the long end of the curve, because if they can lock in an interest rate, let's just say the 10 years trading at 4 or 5%, and they see growth in inflation, let's say over the next 2 or 3 years at 2%. So they're like, hey, I'm going to go ahead and lock in that 4% completely risk-free. And so what happens is you get demand at the long end of the curve, which brings interest rates down because there's an inverse correlation
Got it.
between the interest rate and the price of the actual treasury. So if yields are going down or interest rates are going down, that means the price of the treasury is going up.
Oh, got it. Got it.
Usually what happens is when you get this demand at the long end of the curve because of this, let's say, flight to safety, because they're seeing economic storm clouds, ironically, what happens is the Fed is so far behind that while they're doing this, they start actually increasing interest rates at the front end of the curve because the Fed controls that overnight rate. We call it the Fed funds rate. So whenever you see Jerome Powell on TV come out and saying that he's increasing interest rates by 25 basis points or he's decreasing interest rates by 50 basis points. We just had a Fed rate cut the other day by 50 basis points. That's just the overnight rate. So the Fed is increasing interest rates while the interest rates are coming down at the long end of the curve, and that's why you get that inversion. So then what usually happens is this, and we've seen this cycle play out just many, many times since 1950 in these rate hiking cycles that the Fed does. While the curve is inverted, while unemployment goes up, usually it starts that inversion. Then what happens is we have a bull steepener. Now that sounds kind of weird, but what that means is that short-term interest rates are coming down faster than long-term interest rates. So the curve starts to uninvert. And then
there's two ways it can come down, correct?
Yeah. So what you could have, let's just say that right now, my left hand is representing short-term interest rates and my right hand is representing long-term interest rates. So we have an inversion because short-term interest rates are higher. So you've got two options right here for the curve to go back to normal where it's steep. Number one, the short-term interest rates can come down like this, and then bam, now all of a sudden we're uninverted, right? Or what you can have, let's go back to that, is the long-term interest rates start to go up like this to now we're uninverted.
Okay.
So it's either the front end coming down or the long end going up. Those are the two ways that you can get that uninversion of the curve. And if short-term rates are coming down, we call that a bull steepener. And if long-term interest rates are going up, we call that a bear steepener.
And the bull steepener, you said, is more something we don't want.
Yeah, that's the
more negative.
Yeah, that's a signal that the Treasury market is saying the Fed is offsides and the Fed should be dropping interest rates sooner than later because the economy is getting more unhealthy.
Got it.
And this is usually why you see the 2-year Treasury really coming down quickly. And if you go back, even to the 1980s, you see pretty much every single time we have one of these cycles, the 2-year Treasury precedes the Fed move. That's why people like Jeff Gundlach always say the Federal Reserve really just follows the 2-year Treasury. And so right now, as an example, Fed dropped by 50 basis points to 4.75, but the 2-year Treasury was at the time trading around 3.6 or 3.7. So the 2-year Treasury is telling the Federal Reserve, hey, you need to drop by a lot more, more.
Because that curve uninverted recently, like September.
Yeah, so about 3 or 4 weeks ago, it uninverted, and you would usually what happens is the curve uninverts, and then the Fed starts dropping rates.
Okay.
So it uninverts just before the Fed starts dropping. The Fed drops, and then it really steepens out.
Okay.
Because let's just say Fed funds is at 5.25%, and let's just say the 10-year Treasury is trading at 4%, let's just say. And then what happens is the 2-year Treasury starts trading down, that precedes the Fed move. And then the Fed drops, which usually makes the 2-year Treasury drop even further, right? Which steepens out that curve.
Okay.
Because it drops further below the 10-year than it was before the Fed cut rates to begin with. Okay. That's usually what we see. So, but what's really, quite frankly, unprecedented is just today, in fact, just this morning, the curve reinverted. And I did a so it's back to, it's going to get a little confusing here, but this morning prior to the market opening up, it reinverted to where the 2-year Treasury went back above the 10-year just momentarily. because as we speak right now about call it 2:30 Eastern time, the curve went back to where it was uninverted by maybe 3 or 4 basis points. So we'll have to see how this plays out. But
And
even
what do you think that signals? I mean,
so that goes back to the jobs numbers that we got on Friday. So it's a couple things. It's the jobs numbers on Friday and the belief from the at least, the mainstream media and a lot of the talking heads and therefore the general public that the economy is booming. The economy is doing really well. The
oh,
economy is on
and no.
fire. The economy is growing rapidly. The Fed have orchestrated not just a soft landing, but a no landing whatsoever.
Oh
And the
my god.
Fed is actually cutting interest rates by 50 basis points into a very, very healthy economy, which is going to turbocharge the
Oh
economy.
my
And then
gosh.
you get the confirmation of the non-farm payroll on Friday, which came out at, I believe, 255,000 when the
Which was a lot higher than they were expecting, right?
way higher. It was
Okay.
a blowout number. So you
Now, no,
combine
are those numbers real, George?
look, uh,
Just had to ask.
yeah, so here's what I'll say, and I'll let your audience come to their own
Okay.
conclusions. About 2 months ago, we had a revision to the prior year of non-farm payroll where they revised the jobs down by almost a million.
Wow.
Almost a million.
Wow.
I think right off the top of my head, I think it's 818,000.
Jeez.
So that is in fact, I think it was the largest revision down since the GFC. I
Wow.
mean, it was a staggering number. So what that means is that, for the last year, we're looking at the jobs numbers get better and better and better. And then they say, oh, yeah, by the way, we were just joking. The jobs market is actually terrible. And so you had that like 2 months ago. But then what was really odd is about 3 weeks ago, we had the BLS come out and say, oh,
Who's
hey, look,
BLS?
the Bureau of Labor Statistics.
Thank you.
So they're the ones that's in charge of collecting the data and creating these formulas and whatnot. So they came out and said, "Oh, by the way, we know that we revised the jobs down by 818,000, but now that all this new data that we're seeing is even better than we thought. So the last few months we're going to revise the jobs back up, and then what we're going to do is the savings rate was 2.9%, which was getting very close to a historic low. And they said, oh, we're going to revise that back up to over 5% because we're going to assume that the personal income expenditures were $1 trillion higher
Oh my gosh.
than we thought they were before. And, sorry, our bad. So we were telling you the economy is kind of muddling through. But now what we're telling you 4 weeks before the election is that the economy is incredible. This economy is so amazing. In fact, we've rarely ever seen a US economy that is doing this well.
Oh
So
my goodness.
they go from okay, sorry, our bad. We're going to revise down by let's say 1 million jobs to the very next week almost saying, "Oh, guess what? Things are way way
Oh
way
my
better than
gosh.
we
They
thought."
just they're just making this up. Oh my goodness. They forgot about inflation and everything that's been going on?
And then they're saying inflation is coming back down. I mean,
Coming
it's
down, of course it is.
5,
Everything.
the Fed is,
It's
and
all
their target, let's
beautiful.
remember, is 2%, right? So 2.5, but we don't want under that because if it's under 2%, then what that means as far as the narrative,
Uh-huh.
the narrative is, oh my gosh, now the economy could be going into recession because now we're under the Fed's target, and therefore the Fed is going to have to stimulate the economy. But at 2.5, the narrative we can assume that the economy doesn't even need to be stimulated because it's doing so well. The jobs numbers are indicative of the underlying health. And therefore, since the Fed is quote unquote stimulating by dropping rates, then this just means, like we said earlier, that the economy is off to the races. And the Fed is now just completely turbocharging the economy. And we don't really have to worry about inflation because we've seen it come from, let's say, 9.1% in June or July of 2022, all the way down to 2.5. So they're assuming that the Fed is just absolutely sticking the landing to where we can bring inflation down, while at the same time we can grow the economy and make the economy even healthier than it was to begin with. Let's just say in 2019. This isn't just a narrative right now. I mean, I would challenge any of your viewers to watch CNBC. I don't know when this is going to come out, but if they could watch it, tomorrow or something like that, just watch the talking heads on CNBC and what they're like, Jim Cramer, and what they're saying about the economy. I mean, they're literally euphoric. Like they can't even believe how awesome everything is
Yeah,
because
because it's not. They can't believe it because it's not.
yeah,
Oh,
so
anyhow.
that's why we saw so going back to the original point, that's why we saw this, let's say, re-inversion, because the 10-year Treasury has moved up and we were talking about oil as well. So you have all of these factors because we got oil going up as a result of the Middle East, and then we could have a short squeeze on oil as well, which we'll save that.
Okay, well, hold that thought, because we're going to come back to that. We're just going to take a quick break, George, and then we're going to be back. We're going to talk about the Middle East. We're going to talk about oil. We're going to talk about all these things that seem to be kind of a perfect storm heading our way or already on top of us.
Yeah, they're all converging on us at one time.
Yeah. Okay, we'll be right back.
Are you worried about your financial security in these unprecedented times? If you are, the next minute could profoundly impact your financial security. Imagine waking up to find the economy has plunged and your portfolio has plummeted 30 to 45%, while banks are in turmoil, holding your money hostage while waiting for FDIC intervention. Where would you turn? For many, this may sound like fiction, but it's a stark reality for those that have money on the line. Recently, America's awoke to both the NASDAQ and the Dow, plummeting over 1,100 points each and triggering a frenzy of sell-offs. History shows us how a single event can crash the market, like the dot-com bubble of 1999, the subprime mortgage crisis of 2008, and the pandemic of 2020. But today, we're facing multiple bubbles: commercial real estate, stock, bonds, and banks. Combined with the relentless inflation, the threat of global recession, the specters of war, and you have the perfect storm. The consequences could be catastrophic, plunging us into unprecedented crisis. America is sliding in the age of discord, with trust in institutions collapsing and the democratic norms unraveling. The quality of life for Americans has declined. Wealth is concentrated among the rich, while the median American family income stagnates, creating a dangerously top-heavy social pyramid. Moreover, hostile countries like Russia, China, and Iran are working to destroy the U.S. dollar. Gold is a no-matter-what store of wealth that you need. That's why Robert has been such an advocate of gold, and he trusts Allegiance Gold. Allegiance Gold is ready to help you incorporate physical gold as part of your portfolio and protect it against economic uncertainty. Visit protectwithrobert.com today to learn how you can qualify for up to $5,000 in free silver with a qualifying investment. Or give them a call at 844-3-ROBERT. Remember to mention Robert and Kim sent you when you contact Allegiance Gold. Secure your IRA or 401k today with Allegiance Gold. Visit protectwithrobert.com or call 844-3-ROBERT.
Hello and welcome back to the Rich Dad Radio Show. I'm Kim Kiyosaki, hosting today's program with George Gammon, my favorite go-to guy when I want to find out what's going on economically in the world and globally. And right now we are looking at a perfect storm, and it's not very perfect, actually. And George, you talked about the economic storm clouds that these people are seeing, that the banks are seeing, that people in high places are seeing, and they're responding to it. So what is making up the perfect storm? How is it all coming together? Because the one thing that you do is you look at all the different facets and kind of put it together in terms of how they all interact and how this could impact. There's so many pieces that could impact our economy right now and the world.
Yeah, like we were saying before the break, I mean, it's really unprecedented what we're seeing right now in the yield curve. I did a video this morning where I went back and looked at all these cycles going back to 1980, and I couldn't find a cycle where the curve reinverted after the Fed started dropping rates. I couldn't find it. So this is
So we don't know. We
truly
really don't know what that means, do we?
no, we don't know what it means, but I'm guessing it goes back to the view of the mainstream media
Yeah.
that the underlying economy is extremely healthy, while at the same time we have oil prices increasing as a result of what's happening in the Middle East. And a lot of the experts, and let's just say talking heads of the market, seems to think that those higher oil prices, if sustained, could trickle through the United States and lead to higher rates of inflation. So when you have that combined with what we were talking about prior to the break, with this euphoria around the health of the economy, that means inflation and growth expectations increase, which would make sense when you see the yields going up on the yield curve, especially the 2-year Treasury going up a lot faster than the 10-year, which has created this incredibly rare, unprecedented re-inversion of the curve. And we were talking about the CME group, I believe, prior to going live, and they just do kind of like the betting odds, if you will, based on different market indicators for the next Fed meeting as to, are they going to cut 50? Are they going to cut 25? And just last week, the debate was between 50 and 25.
Right.
Right off the top of my head, I think it was maybe like 20% for a 50 and 80% for a 25. Now, as of today, the 50 is at 0%.
It's not going to happen.
Well, it's going to change.
According to this,
to them right now, the 50 basis point is completely off the table. 0% chance they do that next meeting, and the 25 basis point cut, I believe, is at 80%, and no cut at all is at right around 20% odds. So this is really crazy stuff. And what's frustrating, I think, for the average person is when they juxtapose what they're hearing from the Federal Reserve and from these data points to what they're seeing in their own life.
Yeah. At the food store, at the gas pumps.
Exactly. Yeah. It's their purchasing power is declining. They're finding it hard to maybe get a job.
Yes.
Or to find a different job if they want to relocate. They're talking to their friends, and their friends are saying the exact same thing. And they're looking around themselves and just saying, oh, booming economy. I don't, huh? Like, how are you coming to this conclusion? And I think that I think they're right. The guy in the street is absolutely right. That would be my base case. And I think that over the next 6 months, or maybe over the next 9 months, you never know how to time these things, that the average Joe and Jane that are watching your program right now saying to themselves, no, the economy is not doing well. It's actually, or no, the economy is not doing well. It's actually doing very poorly. They're going to be the people that are proven correct. And by the way, this exact same thing happened, not with the uninversion of the curve, but with the interest rates. The exact same thing. It's almost scary that it's just a mirror image, or kind of a carbon copy, maybe is a better way to say it, as to what happened in 2007. So I don't know if you know this, Kim, but the last time that we had a 50 basis point cut was in 2007, prior to the GFC. And you know what the date was on that?
No. September
18th. No, it's the exact same day.
Wow.
And by the way, you know what they dropped the rates to?
No, what?
4.75. Which is, if you guys aren't following me here, this last rate cut that we got from the Fed, which started their rate cutting cycle, was September 18th, and the Fed dropped to 4.75. The exact same thing, the exact same day, exact same date as 2007.
And then we had the great financial crisis.
Yeah, but let's focus for a minute on what happened to interest rates as far as the long end of the curve. Because see, what we've been talking about with this reinversion, that has to do with the entire curve. But if we actually look at what happened at the long end, let's just say that, let's focus on the 10-year Treasury to keep it simple. What we're seeing right now is literally exactly what we saw during 2007 when they started cutting rates back then. So I know Sarah can go ahead and put this up for us, but I'm going to go to a quick chart
Okay, thank you.
As a reference point. And before I do, let's just, for the audience, they can maybe make a mental note. The first rate cut in 2007, like we said, September 18th, 50 basis points, dropping their overnight rate to 4.75. The next one, Kim, was on October 30th, and this was 25 basis points. And then they dropped another 25 on December 11th. Now, I'm only going to go over two more, but these are very important. Then moving into January of 2008, they had an emergency meeting, January 22nd, where they dropped by 75 basis points. And then just 1 week later, at January 30th, they dropped by another 50 basis points. So in January of 2008, within a span of 1 week, they dropped by 125 basis points. So 1.25%. So you would think that if the Fed is dropping this aggressively, that this would be a signal to the market that the economy is really suffering, and the economy is, quite frankly, going off a cliff. And therefore, you would expect the 10-year Treasury to go down. In fact, you'd expect the 10-year Treasury yield to plummet, right?
Right.
But what's fascinating is, if we'll pull up a chart here of the actual 10-year Treasury going back to that time frame. Where is it here? And I've zoomed in, and again, Sarah, I'll send you this chart, but we can highlight these specific dates we just referenced. So if we start at, let's say, September 18th, over the next, so September 18th, the 10-year Treasury was trading right about 4.5%. But we see moving into the first couple weeks of October, October 12th, it was actually trading 20 basis points higher. Exactly what we've seen. So the Fed drops by 50, and the 10-year Treasury goes up by 20 basis points. And then they have the October cut, which brings the 10-year Treasury yield back down. But then they had that emergency meeting. Remember that?
Yep.
In 2008. So that was January 22nd of 2008. They have the emergency meeting. They drop by 75. And then a week later, remember the 30th, they drop by another 25, or excuse me, another 50 basis points, bringing it to 125. Well, at this time, the 10-year Treasury is trading right around 3.5%. Okay. Now we what's unbelievable is we fast forward another, let's say, 6 months. So take it to June of 2008, and the 10-year Treasury was trading at 4.27.
So it went up.
It went way up. So now let's go to a chart of the actual Fed funds so we can get kind of a better visual. Let's see where I've got this. There it is. And but we can look at January right here. We're right around, call it 3.75% roughly. And then they drop all the way down over the next 6 months to 2%. So Kim, let's think about this. They go, just to keep the math easy, they went from roughly 3.5% all the way down to 2%. And at the same time, the 10-year Treasury yield went up.
And every indicator you're saying by these cut is signaling that the economy is in terrible shape.
Right. But what happened back then, it was the exact same narrative that we have right now. Is that every single time the Fed cut, not every time, but a lot of times when the Fed is cutting, doing these emergency rate cuts and everything, the market takes that as, oh, great, the Fed's bailing us out.
Yeah.
The Fed's bailing us out. We've got nothing to worry about. Because even if we were headed toward a recession, well, now that they've done all these emergency cuts,
economy's going to be great.
Now everything's going to be great, because even if we were going into a recession, now we don't have anything to worry about because they've cut so much. There's no way that we can go into a recession or a hard landing now.
So are you saying that now they don't even have to cut anymore because they already have that narrative that the economy is great? Are they going to continue to cut?
But my point is, that's what happened back in 2008.
Yeah.
It's exactly what happened. Is the economy was on fire until it wasn't.
Yeah.
and then that's when you get the Wile E. Coyote moment, where he runs off the edge of the cliff, and he's fine until he looks down, and everyone knows what's happening or knows what happens. So I'm not saying that this time is an exact replica of 2007, and therefore we're going to have a GFC 2.0 or anything. I'm just saying that so far, this cycle is eerily similar to what happened in 2007, not just with September 18th, not just with the 50 basis point cut, not just with coincidentally going down to the exact same number, 4.75, but also the price action or the yield on the 10-year Treasury. And it's all what's really weird too, that and something that's fun to think about is the most important interest rate for the economy is the 10-year Treasury,
Okay.
because that's what filters straight through to mortgages, as an example, and to most of the interest rates. And some of the interest rates are more short term, but most of the interest rates in the real economy are going to be kind of a derivative of the 10-year Treasury. So what's ironic is what may have happened prior to the GFC is because the market got so optimistic on their future growth and inflation expectations from the Fed dropping rates so aggressively, the 10-year Treasury, like we said, goes up, which causes even more havoc in the economy that was already suffering. And that could have been the straw that broke the camel's back that brought on Lehman, Bear Stearns, the GFC. And we couldn't, I'm not, again, this is not a prediction.
Right.
It is something I think that we need to be cognizant of, that this cycle could play out almost the exact same way, where everyone gets so euphoric about the economy that longer term interest rates actually go up while the Fed is dropping rates to try to get ahead of the recession. And those interest rates going up are actually the catalyst to the hard landing, because that's what pushes the unhealthy economy just right off the edge.
Got it. So really, for our viewers and our listeners, you're saying, really pay attention to the 10-year, pay attention to what the Fed does with rates. Now we know what happened in 2002, 2007, 2008. Is that happening again? And is there any narrative at all, George, out there about inflation? Because I'm not hearing it.
Yeah. I mean, that's part of what's bringing interest rates up, is this idea that, and also too, we forgot to talk about China stimulus. I think that plays a lot into what's happening with interest rates and commodity prices as well, because they were quite literally in the China's version of the GFC. And I'm not exaggerating at all. I mean, their real estate prices came down probably by 50%, at least in the major urban areas. I mean, they are literally going through a GFC.
Currently.
Currently, as we speak. So their government came out with all these, incredible, literally unprecedented for China, stimulus programs, where they're not just trying to stimulate the banking system and trying to incentivize them to lend, but they're also stimulating the real economy by sending out stimmy checks.
I was going to say, when you're saying stimulate the economy, you're talking about QE. You're talking about printing money. Correct?
I'm talking about they're literally sending out stimmy checks.
Okay.
So they're in there doing things like they've opened up lines of credit for people to buy stocks.
Oh.
They've actually they did something with the local municipalities where they gave them some sort of financial incentive to take the real estate, all these ghost cities, and put them onto their balance sheet to get that supply offline to try to stabilize prices. I mean, they're doing just some intervention that is obviously going to lead to economic distortions that are mind blowing. I mean, the amount of unintended consequences that are happening as a result of this type of central planning is going to be, an economic price that unfortunately the Chinese people are going to have to deal with for a long time to come. But
that's also going to affect the entire world.
Yeah, absolutely. Absolutely. And it depends on how much they actually do. And a lot of the narrative in the market revolves around, even if this stimulus that they're doing is ineffective, then what will they do next?
Yeah.
And a lot of people think that they'll just double, triple, quadruple down. And the only way to double, quadruple, or triple, quadruple down is to buy commodities so they can build more ghost cities. And so then you get the price of copper booming, you get the price that could be leading, or this could be contributing, I should say, to the price of oil. And therefore, the narrative is that could trigger another bout of inflation in the United States. And that could be playing into the yields that we're seeing. And one of the reasons why the yields are going up, not just at the long end, but the front end, because this is the market saying, okay, the Fed might have to pause these rate cuts that were priced into the market. And who knows, they might even have to hike again. Now, this would not be my view at all, at all. And one of the reasons I say that, Kim, is because if you believe that we are going into recession, which means that you believe this time isn't different, that this cycle, we can't get the timing right, who knows, but this cycle will play out the same way these cycles have played out going all the way back to the 1950s, with very few exceptions. If you believe this time is not different, then you also believe that at some point, the next 6 months, 9 months, whatever, we will be in a recession. And if you believe in a recession, you can't believe that we're going to have an acceleration of inflation.
Correct.
And why do I say that? The reason I say that is because I've gone back and done a lot of research on this, especially in the 1950s, because that's when you hear stagflation, which implies that the unemployment rate is going up. You're going into a recession, while at the same time, the inflation rate is actually accelerating, right? And this is what people are talking about right now, that we're going to have the CPI. And I know the CPI understates inflation. Everybody knows that. So that's not even debatable. But what we have to do is we have to look at the headline CPI for the rate of change and what the trend is doing. And then the market is actually going to trade off that CPI as if it is legitimate. So we have to pay attention to it.
Got it.
So the narrative there that we're focusing on is the CPI is going to go from 2.5 to 3 to 3.5 to 4 to 5 to 6, possibly back up to 9, where it was before, because the Fed is cutting rates when they should not have. And you combine this with China stimulus, you combine this with everything that's happening with oil, et cetera, right? The reason I completely disagree with that is because if you look at all of these recessions that we've had going back to 1950, there's literally none of them that where you see a reacceleration of inflation. Every single one of them, without fail, you see disinflation, even in the 1970s. So as an example, we always talk about the recession that we had 74, 75. And this is when I believe inflation, going into that recession, was right around 12.
Yeah.
And back then they calculated it much more honestly and accurately. So let's just say we're right around 12 or so. But by the time you had that big unemployment spike, which is what you always get in the middle of a recession, the inflation rate started to go down, and it went down, 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 down. Now we still had inflation, but the rate of inflation was decreasing. So this is disinflation.
Okay.
Different than deflation when prices are outright declining. So my point there is from 70, call it Q4 of 74, for the next year and a half, you saw disinflation, where inflation went from, let's say, 12 all the way down to, I think it was 4. I don't have the chart in front of me. And then in 1980, you saw the exact same thing, where you had the next recession, and you saw the CPI go from, let's say, 10 all the way down to maybe 3 or 4, something like that. But it kept going down for 2 years. 2 years. So the punchline is, we've, in the United States, as far as I can tell, going back to the 1950s, we have never had a recession with the big spike in unemployment and have inflation accelerate.
Yeah.
It always goes back down. And now, after the recession is over, after that year or 2.5 years, based on the government intervention and the distortions that they create in the economy, then yes, absolutely, you can see a reacceleration of inflation. And that would be my base case.
Okay. Got it. So my final question is, if that's the base case, I'm going to make an assumption. I'm just guessing at this point. this recession that will come will be greater than the GFC. Yes?
It
Don't know.
depends.
We don't
I
know
I could give
all
an
the
argument
factors.
as yeah, so I could give an argument as to why it would be, and I could give a very good argument as to why it won't be. And my argument why it won't be is because now the Federal Reserve and the government is much more of an interventionist,
Mm,
where if we have especially if it's a quick decline of the, let's say the stock market went down by 20%, while at the same time we get some negative numbers on the non-farm payroll. If that happens, I can
and
almost
they're gonna jump in.
assure you that the Fed is gonna drop down
Yep,
to, who knows, 1%. They're gonna start doing QE again.
yep, yep,
And probably more importantly, the government is going to do some sort of fiscal stimulus. They're going to start UBI. They're going to do stimmy checks. They're going to do whatever. They're going to do the exact same thing China's doing. My
yeah,
point is, if this would have happened back in 2001, they would have maybe stood back and said, okay, let's just see how this plays out. Where now, just they're, as soon as they see those numbers start to decline in a way that is worrisome, they're going to
they're
step
gonna
in
jump in.
and try to prevent everything. And they're going to, just like China, probably double, triple, quadruple down to the point where we could see the Fed buy stocks, and we could see the Fed buy housing. I mean, who knows what they'll do to try to prop up asset prices. And, long term, obviously, that's terrible because
Yeah,
we're all going to pay the price. And the example there that I give is just ask yourself if life, your standard of living, or your purchasing power is better or worse now than it was in 2019.
right,
And I
right.
would bet probably 90% of your audience would say today it's actually worse.
Yeah,
Why is that? Well, that's because of the economic distortions that were created by the government in 2020 and 2021 when they're locking everyone in a cage, shutting down the global economy, completely destroying global supply chains, while at the same time increasing aggregate demand by sending checks directly to people for a problem they caused. I mean, let's
yes,
be honest here.
yes.
So there is no free lunch, but that's why I would argue this recession. In fact, I think what may play out is the more gradual the recession is, and the more shallow the recession is, you could argue that it will even be worse than it otherwise would be, because that will allow the government to stand back and not really do anything. Where if we do see a deep, steep
Oh, that's
decline very
interesting.
quickly,
Yeah,
like this, COVID, then they'll come in all guns ablazing, and with all these economic distortions, to where that recession will be like a month, as opposed to maybe 6 months or a year if we just have a slow, gradual, shallow type of recession.
got it, got it. So we're out of time, but I do have one final question I just gotta ask, 'cause what would you say to people because there's so much uncertainty. How would you advise them to prepare?
Well, with their portfolio, I mean, you got to own gold. I mean,
Yep.
that's the only problem with gold is if we get a liquidity event like the GFC, usually gold really takes a hit because it's doing its job and it's the only thing that's liquid. But bottom, even if it does go down, I mean, you got to have something like
Yeah,
that with no counterparty risk, for heaven's
right.
sake. And right now, I like T-bills, especially rolling them over as interest rates go up. But the good news is you've got to start a watch list of things that you'd like to buy and things that you'd like to own if asset prices get lower.
Great point.
It's not just doom
Yeah,
and gloom. You've got to be
yeah,
very realistic about the probabilities, and then also you've got to ask yourself, how could George be wrong? And I ask myself that question every single day. I say, how could this time actually be different? And so if you start to see the Fed pause, and if you start to see good, or continue, I should say, to see good unemployment or data as far as the unemployment rate going back down,
mhm,
and then you start to, or we continue to see these non-farm payrolls exploding higher, for the next 6 months. And then you start to see that bear steepener where the Fed is pausing, but the 10-year Treasury keeps going up and up and up and up to its historic norm. I think its historic norm is about 120 basis points above Fed funds. So let's just say Fed funds stays at 4.7. If you start to see the 10-year Treasury with all the economic data getting better and better and better go up to let's just say 5.25 or something like that, then that would be an indication that George Gammon is wrong and the yield curve is wrong, and that we very well might get a no landing, and then you've got to reposition. But even in that environment, gold likely does really, really well.
Right, right. I'm gonna guess George is right. I'm gonna put my money on
I
you.
would say there are no certainties, there are only probabilities.
I know. Well, thank you, George. This has been fantastic. And I love that you give everybody indicators to look for as we move forward, because it makes so much sense, as nobody's really telling the truth, and that the economy is booming and it's just going to go off to the moon. It's just exciting. Oh my gosh.
We got to pay very close attention to the numbers, especially after the election.
Okay.
That's really what I'm hyper focused on, because let's assume that right now they are kind of they're doing some, let's say, window dressing.
Yeah.
To be very polite. After the election, especially if Trump wins, then you could see the number. Oh, yeah, you know what? We revised them up, Kim, but now all of a sudden we saw that our models were broken. We're revising them all down by another million, by another million jobs. The economy's terrible, and it's all because you guys elected Donald Trump. So I'm going to be very, very focused on if the numbers change substantially after the election, especially.
Love it. Well, the narrative, if Trump wins, the narrative isn't going to be anything good in the media.
Yeah.
Everything's Donald Trump's fault. That's how it is. Yeah.
Yeah.
Okay. Well, thank you, George. It's been fantastic. I so appreciate you, and I so appreciate your time, and I wish you the best, and I can't wait to see you when we see each other next.
Yeah. I look forward to it.
Yeah. Thank you. Take care.
This podcast is a presentation of Rich Dad Media Network.